So you're basically saying unrealized losses. Basically, a lot of these banks invested in things like treasury bonds when interest rates were really low. And as the Fed kept hiking up interest rates, those investments were basically becoming devalued. And you didn't actually lose any value unless you're forced to sell the treasury bonds. And these banks, so it's unrealized. You have a loss on paper, but you don't have it in real life until you actually have to sell it. So you're saying a lot of these banks had unrealized losses, which are scary, but only actually impact you if you have to sell the bonds. Go ahead.
Right. I think that's very well said. But the thing to understand is, even though the losses may be unrealized, the value of those bonds has gone down because the value of bonds moves in the opposite direction of interest rates. And as we know, interest rates have spiked over the last year in a way that we haven't seen in decades because we're dealing with the worst inflation in 40 years. This leads us to SVB. They had about $80 billion of mortgage bonds. Even though they're a startup bank, they serve Silicon Valley, I think it's important to understand that they got in trouble not because of some sort of risky startup behavior. They got in trouble because they basically bought a bunch of mundane, boring mortgage bonds. And the value of those bonds got decimated over the last year, and their capital basically got to the point where they needed to they basically needed to raise emergency capital. And when they announced that they were going to have to do a stock issuance, the hedge funds got a hold of this, their share price basically tanked, and then a run on the bank started on Thursday. People basically began to worry that it was insolvent. And then on Friday, the Fed stepped in and took it into receivership. And that was the start of this crisis. But if you look at what's going on now, in the stock market today, on Monday, this is a much bigger problem than Silicon Valley Bank. You're seeing now trading was halted this morning in roughly half a dozen major regional banks. The bond market now has rallied significantly. It is betting that the Fed will now have to cut interest rates because banks are in trouble. And so, I wish this was just a story about SVB and Silicon Valley Bank, but it's a much bigger story than that. And this is where I took issue with Vivek's take on this, is that he basically said this was a Silicon Valley problem. We shouldn't bail them out. We shouldn't worry about it. This is no systemic risk. And 2 hours after he wrote that piece in the Wall Street Journal, Signature Bank in New York was seized by regulators. There was a run on the bank that started on Friday. And now we see this huge problem in all these other banks on Monday. So this is where I fundamentally disagree with Vivek. I think that we probably share a lot of views in common about a lot of things, including where SVB mismanaged its finances, because certainly they did a bad job. But this is a much larger issue because of the fact that the Fed has slammed on the brakes after basically running the American economy at 150 miles an hour. So that is the wreckage we are starting to see right now. And we can talk about SVB, but we should also talk about the larger problem in this economy.
We're definitely going to get to all of that. And Vivek, before you respond, just to add some more meat on the bones of the background, because I didn't know anything about this prior to this story breaking on Friday. It's kind of an interesting thing. So tech kind of has its own bank, and it's this bank. And yes, they invested in all these so-called safe government bonds, like these treasuries and these mortgage-backed securities with the low interest rates. But I know you've been pointing out those interest rates going back up was foreseeable, and other banks foresaw it and hedged their investment portfolios accordingly. SVB did not, which is one of the questions you've been raising about whether they deserve help. So they were living large for a long period during the tech bubble, 2021, post-pandemic, during pandemic, all these tech companies did so well. They hired a bunch of people. They were in the bubble. And then post the bubble, like it's been popping in tech before it popped anyplace else, not only have those companies been doing less well, and their deposits into Silicon Valley Bank have been going down, and they need to withdraw more to cover payroll and things like that. So SVB's coffers are less full. But then the Fed steps in, starts hiking up the interest rates. So the value of their portfolio, the SVB's overall, is going down. So it's a bad combo. The money is being pulled out, and the money they're taking in is going down. And so it leads to sort of a crisis. And then, as David just made reference to, this is kind of an interesting thing about it. So the investor money's drying up. The depositors begin withdrawing money to make payroll. SVB needed to raise money to meet the withdrawals. The Dispatch news service had a great write-up on this. I'm quoting from them in part. Then they had to sell a $21 billion portfolio. Well, no, sorry. Let me revise that. Then to shore up the resulting hole that they had in their balance sheet, they announced a capital raise of $2.25 billion. That's what they had to do. And that's when the panic ensued. They announced that they were shoring up their suffering balance sheet and that they needed a capital raise of $2.25 billion. That's all. But then panic ensued. And on Thursday, customers withdrew $42 billion. So their position, Vivek, has been, we could have covered the $2.2 billion. If we had like somebody come in and help us, we could have gotten that. No bank could cover $42 billion.
Well, here, one of the issues that probably Dave and I agree with. I mean, this was mismanaged at the level of the CEO, who actually, I think, in a bad act, sold stock just several days before the calamity, but also botched the communication, right? They only, in securities filings, cryptically said they were raising equity capital. That didn't instill confidence. And then he committed the telltale cardinal sin during a bank run of admonishing his own customers to stay calm and calm down. So no better way to actually drive a bank run crisis than that. But I want to actually put my finger on a really important point here. What we saw on the last day, because I think Dave and I agree on a lot, let's focus on where we disagree for the sake of the discussion. This was effectively a bailout of Silicon Valley tech startups. That is who the customers of Silicon Valley Bank were. And it's important to see exactly what this was. It's not a bailout of Silicon Valley Bank. Everyone agrees on that. The equity holders in Silicon Valley Bank are crushed, as they should be. But this was a bailout of tech startups in Silicon Valley who chose to bank with SVB. And what does this do? It incentivizes some really bad behavior. I think a lot of folks in Silicon Valley have somehow gotten addicted to this mentality that financial discipline is not their job. There's CFOs I've talked to in the last 48, 72 hours who didn't even know, CFOs of multi-billion-dollar tech startups, who didn't even know what the deposit insurance limit was from an FDIC perspective. Roku, inexplicably, I just to give you another example, Roku, inexplicably, it's like an $8 billion some odd public company, something like that, had close to $500 million balance on balance with Silicon Valley Bank itself without diversifying. And I just think one of the things that we're doing here is rewarding that bad behavior by saying that even though you didn't do your diligence, even though you weren't exercising basic financial discipline, we're still going to reward that anyway. And then the dirty little secret here, Megyn, is that Silicon Valley Bank, and also all the people around it, but Silicon Valley Bank included, lobbied for years for lower capital requirements and lower risk requirements on the express thesis that they were not systemically important. What does that mean? It means they're saying we're never going to be important enough for the federal government to step in and save us and treat us any differently anyway. That's why we get to take greater risk. That's why perhaps they didn't even want to engage in interest rate hedging, though any other professional bank would have done it. And yet, in their hour of need, what does everyone in and around Silicon Valley argue? They argue the bank run thesis that it is indeed systemically important. And I just think that's hypocritical, and it's a problem. And I think we got to separate this question of how we would have handled Silicon Valley Bank, which is the bigger of the two, significantly bigger in scale than Signature Bank, and also came first, and also it's worth talking about. Silicon Valley Bank versus how we want to handle a bank run on the rest of the banks across the country. So I think that there's a way to separate this. In my Wall Street Journal op-ed running in print today, I separate the two. If you want to raise the FDIC deposit insurance maximum above $250,000 for everybody, that's a reasonable conversation to have. The Federal Reserve is the lender of last resort to all banks in this country. Great, there are other mechanisms. But I think it really sows well-founded mistrust when you change the rules on a whim, on the fly, after the fact, for whichever darlings might be the greatest favorites. And the arguments I heard over the weekend were really, I think, discouraging to me, all the way from one end of the spectrum saying that, no, these are America's entrepreneurs, the chosen class, the special ones driving the American economy. I mean, the number of calls I got, people throwing spaghetti against the wall, that's one argument to compete against China. I think that actually captures the essential intuition here, is that these are the people who deserve to be saved, even if they're playing by a different set of rules than everybody else. To then saying there's going to be a bank run across the rest of America, when in fact, if that's really the case, you could handle that in a lot of different ways than just bailing out a bunch of tech startups who are banking with Silicon Valley Bank. And I think this is just going to incentivize more of that poor risk.
Let me explain this, the quote unquote bailout that's actually happened. So what happened was on Friday, the FDIC assumed control of the bank. The management was removed after this $42 billion is withdrawn. And he's the CEO is up there saying, Greg Becker, stay calm, as you point out, not calming in any way. So the FDIC seizes control. Then they announced, the Treasury, the Fed, the FDIC announced no losses associated with the resolution of this problem. This Silicon Valley Bank will be borne by the taxpayers. They now announced late last night they are stepping in to save, the feds are stepping in to save this bank essentially, but not with taxpayer dough. They say they're going to tap into The FDIC insurance fund made up of premiums paid by banks, not by taxpayers, that they will then replenish that fund with a, quote, special assessment, not on taxpayers, but on banks. And so that's supposed to make the taxpayers feel better that we're not paying for. I mean, my general philosophy is we always pay in the end. The bank customer always pays in the end. Why would the banks just suck it up and not pass it along to the customers however they could eventually? But we can get to that eventually. The regulators, meantime, are seeking a white knight. They want somebody to step in and buy the bank and its assets. HSBC, another bank, bought at least the UK version arm of SVB for £1. But so far, no takers on the American end. And that's where we are now, with the feds in control, assuring us, David, that we are not going to pay for this. But before we get to that, can you speak to some of Vivek's points about how, this is just the special class, and they told us all along that they weren't supposed to be essential, and that's why they were allowed to proceed under this sort of loosely regulated scheme as opposed to that imposed by Dodd-Frank, which everybody else had to do after the '08 crash.
Well, okay, let me start with a couple of points where I agree with Vivek, and then I'll go to the points where I disagree. So the part where I agree is that the management of SVB did not do a good job managing their risk. They deserve to go under. No one, as far as I know, supports a bailout of SVB. Its stockholders are wiped out. Its bondholders are wiped out. Its stock options are wiped out. The executives are disgraced. They're probably going to spend years in litigation. Nobody is saving SVB. The question here is the depositors. And I think Vivek here is really simplifying the customer mix. You had 40,000 small businesses who used SVB to do their banking. And many of them are just, small companies, 10 to 100 employees. These are not big tech companies. These are companies that have to run payroll on Wednesday. If they didn't get access to their money today, as the Fed provided, they would be furloughing and firing employees. They have employees all over the country. They have customers all over the country. There was a CEO of one of their customers who lives in Columbus, Ohio, and she says she drives a Honda and basically took on a second mortgage to help fund her startup of 15 people. So I think it's a gross simplification here just to say these are a bunch of rich tech fat cats who are going to get hurt, or a bunch of VCs who are going to get hurt by this. This is basically 40,000 small businesses. And I think they need to be protected. I think this position of basically to screw them, I think that is untenable and will lead the Republican Party to ruin. The fact of the matter is that these small businesses they don't have visibility into the balance sheet of these banks.
Sherry from Omaha, Nebraska has this to say about Genucel. I have sensitive skin and I am careful about all products. Then my husband bought me Genucel's immediate effects product and Genucel deep firming serum. Felt it working immediately. Eyes look amazing, face feels smooth, and it diminished the appearance of wrinkles. So impressed, and thanks to Genucel and my husband, I take Genucel everywhere. It's not just Sherry. As you know, Genucel has sold over 1 million products to women and men across this great country of ours. Say goodbye to fine lines, wrinkles, and even those annoying under-eye bags and puffiness from years of endless Zoom calls. And look 5, 10, even 15 years younger, just in time for the warmer weather. Best of all, guaranteed results in as little as 12 hours or your money back. Go to Genucel.com to see for yourself with 70% off their most popular package right now. All their best stuff, including the classic under-eye bags and puffiness treatment. Free shipping and luxury beauty box containing 2 free gifts with every subscription. Go to Genucel.com/MK60. GENUCEL.com/MK60. Hey, thanks so much for watching. If you like what you just saw, hit the subscribe button for more clips and full episodes.